Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions with their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. Thank you so much for listening. Really appreciate your time and attention. If this is your first time listening to the podcast, welcome to the show. And hopefully you're going to find it helpful and valuable in making your own financial decisions. And I can't believe it's already March 1st, at least when this recording is going to go live. It will be March 1st. It feels like this year is already flying by. And since we're in March, that means we are only a couple of weeks away from tax filing deadlines for S corporations, for partnerships, and we are almost a month away from the April 18th tax filing deadline for us as individuals, for C corporations. So since we are approaching these tax filing deadlines, and since taxes is on just about everyone's minds, well, I want to give you a guide to the very basics of how income taxes work. I want to talk through some of the basics of the U.S. income tax system. And I'll talk about 4 to 5 different topics about that. I want to talk about how marginal tax rates work. I want to talk about the income tax formula, or the flow of which your tax is calculated on your tax return. I want to talk about how withholdings and estimated tax payments work. I want to talk about deadlines, different deadlines to keep in mind. And then lastly, I will wrap up with some general tax planning thoughts for you to keep in mind as you're making decisions throughout the year. Hopefully that's going to be helpful for you. So let's dive in here and let's start with the beginning. How do marginal tax rates work? How do the tax rates work? When you think about the U.S. tax system, it's a progressive tax system. And what that means is that the more income you have, the higher the tax rates that you're going to see. Right? The higher your taxable income, the higher the tax rate that you're going to be taxed at. But that doesn't necessarily mean that all of your income will be taxed at a higher tax rate. In fact, there's a common misconception that if you creep into a higher tax bracket, that all of your income is going to be taxed at that higher tax rate. Right? If you start at the 22% tax rate and all of a sudden you are into the 24% tax bracket, well, that means all of your income is now taxed at 24%. Well, that's not actually how the tax code works. Fortunately, it's not necessarily how it works. Instead, it works in brackets or chunks, tiers, and the lowest tier of your taxable income is taxed at the lowest tax rate, and then the next tier or bracket above that is taxed at a higher tax rate. And then the next tier of your income, taxable income, is taxed at a higher tax rate. And it just stacks on top of each other. And only the amount of your taxable income that falls within each bracket, within each tier, is taxed at that specific tax rate. So, for example, if you're married in 2023, your first $22,000 of taxable income is taxed at 10%. Then the next chunk, the income between $22,000 and $89,450, is taxed at 12%. And then the next chunk above that, up to $190,750, is taxed at 22%. And then you get to 24% and 32% and 35% and 37%. So your income sort of stacks up on top of each other in these tiers, and only the amount of taxable income within each of those brackets, within each of those tiers, is taxed at that specific tax rate. So in reality, these marginal tax rates that you most hear about, right, when most people say, I'm in this tax rate, 10, 12, 22, 24, 32, those are really telling you what your last dollars of taxable income are going to be taxed at, or your highest dollars of taxable income. Or that's what that highest dollar chunk of taxable income is going to be taxed at. Or if you're doing some planning and thinking about adding additional income, maybe you are looking at a production bonus, or maybe you're thinking about what additional practice, revenue, and profit will do to your tax return. Well, then these marginal tax rates tell you what the next amount of income is going to be taxed at if you're going to be adding additional amounts. So if you're normally in the 22% tax bracket and you get, for example, a production bonus that puts you into the 24% bracket, that tells you that that last chunk of that bonus, or maybe all of it, we don't know the amount, but that last chunk of income is going to be taxed at 24%. And it may very well be that only $1 is taxed at 24%, but that's just where you're landing at for your last and final dollar. So those are how those marginal tax rates work. It doesn't change how all of your income is taxed, only what falls within each of those tiers or brackets. And investment income may actually be taxed a little bit differently. This is another thing to keep in mind there is that income from, let's say you had a taxable brokerage account, just a regular taxable investment account, the income that account kicks off, whether it's dividends from stocks or stock mutual funds, ETFs, whether it's interest from bond type investments, whether you sell something at a higher dollar amount than you bought it at, that's a capital gain. All of that income ends up on your tax return in the year that it happens, which is different from your retirement accounts. Your retirement accounts don't do that. So the amount of income that comes out of that investment account may be taxed at more favorable tax rates, specifically qualified dividends, long-term capital gains. So a capital gain that comes from something you've owned for longer than a year. Those types of income are going to be taxed at either 0%, 15%, or 20%, depending on your total amount of taxable income. So those specific types of income, that's called qualified income, but those specific types of income may have more favorable tax rate that's taxed differently than your income from work or from business income, net rental real estate income. So you may have a different set of tax rates altogether. There's also this pesky net investment income tax of 3.8% once your modified adjusted gross income gets to a certain level, right? So there's a little bit of additional tax on top of that. But there's another set of tax rates to keep in mind specifically for certain types of investment income. And that's a similar concept for if you sell a real estate property for more than you bought it for higher than your cost basis. Or if you sell your practice, depending on whether it's an asset sale, whether it's a stock sale, certain parts of that sale, that transaction are going to be taxed at capital gains tax rates. So that's the same concept there. If you want to learn more about this, I talked about this in a little bit more detail in a previous episode, episode 34, levers to control capital gains on your tax return. So you can go to my website, optometrywealth.com/34, and you can learn more about those tax rates and how those investment income is taxed and how that works together with all of your other income. That's sort of a summary of how these different tax rates work. Only the taxable income that falls within these tax brackets, within these tiers, is taxed at that specific tax rate. And certain investment income may be taxed at more favorable tax rates. So now let's talk about the income tax formula, right? And this is, what I mean by that is there's a certain flow or way that your tax is calculated, where if you pulled up your federal income tax return, your 1040, you'll see this sort of order and flow to how things are happening. There's a sort of formula to it. First thing I'll say is not all of your income is taxed, right? If you have a salary of $150,000, well, that $150,000 isn't what's actually taxed. There's a flow to figuring that out. And at the very beginning of this formula, and I'm going to try to put a visual in the show notes because it's easier to see visually, but hopefully I'll be able to talk about it in a way that's helpful. But at the very top of this formula is your gross income, which is just any and all income from any source that it comes from. The Congress has a broad power to levy tax on all income from any source, unless it's specifically excluded from your income according to tax law. So if the first section you're going to see if you pull up your tax return is just a listing of all the different sources of income, starting with your wages or salary, Then you're going to see your business income through Schedule C or Schedule E. You'll see net rental income on Schedule E, IRA withdrawals if you're pulling out income out of an IRA, or a pension income, Social Security income, capital gains, dividends, right? You're going to see all of these different sources of income sort of lined up on that first chunk of your tax return. Then below that is going to come adjustments to gross income. So you're going to subtract out certain deductions, certain adjustments that you can take. For example, that's deductible IRA contributions if you're eligible for that, HSA contributions if you're doing it outside of your workplace, outside of your payroll. If you're self-employed, retirement plan contributions to SEP IRAs or solo 401ks, half of your self-employment tax as a deduction. So you'll self-employed health insurance premium deductions. So you're going to see these deductions that you can take as an adjustment, and you subtract that from your gross income. That leaves you with a very important number called the adjusted gross income, your AGI. This is a really important planning point because many deductions, credits, the ability to contribute to IRAs or Roth IRAs, extra taxes that come up, other tax planning points, many of them use this adjusted gross income number, this AGI number, as a barometer to whether you qualify, or sort of the barometer to phasing out of beneficial stuff or phasing into taxes, additional taxes. So this is an important number that we want to keep an eye on. This is also the starting point, the default starting point for student loan payments if you are on an income-driven repayment plan. Of course, you can use alternative forms of documentation like a pay stub, but that AGI number is the first default starting point to figuring out and calculating what your IDR payment's going to be. And also when you're recertifying your income every year, when you're sending it in every year, that's where you're going to start unless you choose to do another form. And all things being equal, a deduction above this AGI number is more valuable than a deduction below this AGI number, because by lowering that AGI number, by lowering your adjusted gross income, you may very well phase into beneficial stuff or phase out of additional tax, right? So all things being equal, you want to try to control that AGI number as much as possible. And once you have your adjusted gross income, after that, you get to take a few different deductions. The first deduction that most people are going to look at is a choice between a standard deduction or an itemized deduction. And a standard deduction is a standard deduction, a standard dollar amount that every taxpayer is able to take regardless of anything else. A standard dollar amount that you're able to take. And in 2023, the standard deduction amount for if you are married filing jointly is $27,700. If you are single, that's $13,850. And that's just going to subtract away from your adjusted gross income to figure out how much of your income is actually taxed. However, you have another option. You can take an itemized deduction. And that's just basically a list stacking up a specific list of categories of deductions that you're able to take on your tax return. It's going to be healthcare expenses above a threshold. It's going to be mortgage interest payments. It's going to be state and local taxes. That's going to be charitable deductions. So there's a very specific list of personal expenses that you're able to pile up, to list out and total. And if that list of expenses, if your itemized deductions are higher than your standard deduction, then you can take the higher amounts of the two. So that next one is either the standard or your itemized deductions. And thanks to the Tax Cuts and Jobs Act in 2017, the vast majority of taxpayers are using the standard deduction because it increased it, just about doubled it for everybody. And so when you hear about things like buying a house and taking a mortgage is beneficial because you may get a tax deduction. Well, you may get is the key phrase there, because most taxpayers right now aren't actually taking advantage of that, at least on a yearly basis. Same thing with charitable deductions. Now, there's ways to plan around that by bunching deductions together in certain tax years. to increase that amount. But in general, in most cases, taxpayers right now are taking that standard deduction. And that's set to sort of phase out and go back to old laws after 2025. So we'll have to see what Congress does. But that's that next set of deductions there. After that is going to be your qualified business income deduction, which if you own a practice or you're self-employed, you'll see this on your tax return. This is essentially a 20% deduction on operating profit from your business. And I'm going to have a whole episode specifically about this because there's just a lot that goes into this over the next couple episodes. So stay tuned. But that's going to come next. So you start with your gross income, you subtract out of adjustments, you have your adjusted gross income, you take out a few other deductions, your standard, your QBI deduction if you are a business owner, and then you finally get the taxable income amount. And that's what actually goes through those tax brackets. As the name implies, that's the amount that's actually taxable. So that amount goes to those tax brackets, and then you have a tax. You have your initial total tax. After that, you look at tax credits. And what are tax credits and how are they different from deductions? Well, a deduction lowers your income, right? A deduction will be subtracted from your income to figure out what your taxable income is. So a deduction will lower the amount of income that's going through those tax brackets. It's actually taxable. A tax credit is a dollar for dollar offset of the tax itself. So a deduction lowers income before it goes through the tax rates. A credit eats away your actual tax that's due. Some common ones that most families see are going to be the child tax credit or the dependent care credit if you and your spouse are working. So those are some things you'll look at. That'll eat away at the tax. And then you'll look at your tax payments, and that's your withholdings throughout the year or estimated tax payments throughout the year. And you subtract that away from your total tax, and then you're finally left with either a tax due that you'll need to pay along with your tax return, or a tax refund. And that means you've paid more into the year than your total tax, and now you're getting a refund for that. So that's the general tax formula, the tax flow that you're going to see. Start with gross income, subtract away adjustments. You have adjusted gross income. You have a few big deductions after that. You have your taxable income, then your tax, take out credits, take out what you've paid in already, and then you have either a tax due or a refund. And this formula is important to us, to me, and other advisors and other tax professionals. Like, this formula is sort of a puzzle to plan around, and you want to see how can you adjust different parts of this formula that are most beneficial for you, and how does adjusting one part of the formula impact other parts? How does lowering adjusted gross income impact other tax benefits or other taxes that you may not have been aware of or have thought of by just looking at it on paper? So to us, this is a puzzle. This is a fun thing to look at and see what we can play around with. But that's sort of the flow of how your income taxes are calculated. So you can take a look and say, okay, these are some things I can adjust, some levers I can pull as I make my own tax decisions throughout the year. Next, let's talk about how withholdings and estimated tax payments work. And in the federal U.S. income tax system, we have a pay-as-you-go system. And what that means is that you're required to pay your taxes essentially throughout the year as you're earning your income. And that's done through two ways. Number one, that's done through your tax withholdings on your paychecks. So you'll see on your pay stub, if you get a pay stub, you'll see that there is a withholding amount for federal, for state, maybe even local tax payments. You'll also see Social Security and Medicare tax payments. So the first way that that's going to be handled is through your withholdings on your just regular pay stubs. So that's the first way. The second way is a system of estimated quarterly tax payments that you're supposed to be paying on time. And those are due in April, in June, in September, and January of each year. And we call them quarterly estimated tax payments, even though they don't really line up with a quarter of the year and they're sort of randomly spread out, right? So we can add that to the list of things about the tax code that don't quite make sense. But you can do these estimated quarterly payments in addition to or instead of those regular withholdings. And Which one will you be using, right? How will you personally be paying those tax payments throughout the year? Well, it depends on how you're practicing, what type of business you're on, and just how your advisors are advising you. So if you're an employed optometrist, you're basically going to be focusing on those tax withholdings on your paycheck, right? You'll pull up your pay stub, you're going to see those, and you would just adjust those throughout the year or at the beginning of the year, towards the end of the year to meet your withholding goal. If you are self-employed and you are taxed as a sole proprietor, so that's if you're a sole proprietor or if you have a single member LLC and you've not chosen to be taxed differently, by default, you'll be taxed as a sole proprietor on a Schedule C, and that's what you'll find in your tax return. If that's how you are taxed, then you don't have a wage income. You don't have a pay stub or payroll to withhold from. So you're going to be making estimated tax payments throughout the year. If you are taxed as an S corp, so if you own an LLC and you've made the decision to be taxed as an S corporation, or if you own a corporation and you're taxed as an S corporation, you do have a requirement to pay yourself a reasonable wage for the work you do, right? So you both have a salary through payroll plus profit on top of that. And so you may have a combination of the two. You're going to be doing withholdings through your regular paychecks that you're going to be paying yourself. Plus, you may decide to do quarterly estimated tax payments. And that's just something you're going to want to talk to your advisors about. What's the best scenario for you? Because you don't necessarily have to do those quarterly estimated tax payments if you're handling the withholdings enough on your paychecks through salary, through your payroll. So really depends on what your advisors are advising you to do there. To incentivize you to, of course, pay this throughout the year, the government imposes under withholding penalties if you don't meet certain thresholds, if you don't withhold enough throughout the year. And the IRS is going to call these thresholds safe harbors. And there's 3 thresholds you can meet. There's 3 safe harbors you can meet to avoid that pesky under withholding penalty. Number 1 is you can get to tax time. And when you file your tax return, you owe less than $1,000. So that's number 1. Number 2, you can get to tax time. And as long as you've withheld or paid in at least 90% or more of that current year's taxes, total taxes, then you don't have an under withholding penalty. Or number 3, if you've withheld at least 100% of last year's total taxes, then you don't have that penalty. If your AGI, again, back to that adjusted gross income number, if your AGI was $150,000 at least or more last year, if you were married, or if you're single and your AGI was $75,000 or more last year, then that bumps up to 110% of last year's tax. So you get 3 safe harbors that you can use to sort of avoid that under withholding penalty. And in general, how should you look at planning around these withholdings? Well, number 1, the ideal outcome for me, sort of my starting point, is that you want to get into tax time with a tax due of 0, meaning you've paid in enough to where you don't owe anything at tax time, and you also aren't getting a refund, right? You've paid in exactly the right amount of taxes that you end up owing. And that's not always possible because income changes throughout the year. We don't know exactly what that'll look like, but that's sort of the trajectory we want to head towards. Because if you get a refund, especially if you get a really large refund, you've essentially overpaid your taxes and you're just getting your own money back with no interest. You sort of lent the government your money and you're getting it back at tax time with no interest. So in general, my general starting point is you want to try to avoid a super large refund. You also try to want to avoid a really huge tax due and try to meet in the middle and pay almost exactly as much as you would end up owing. Now, how do you plan for that? Well, the best situation for me, of course, in my mind, is to work closely with your financial advisor and or your tax professional to project out your taxes throughout the year and to adjust your withholdings and estimated tax payments based on that, and then review that throughout the year as your income unfolds. And if you are making estimated tax payments, it's likely your tax professional, your tax preparer added suggested estimated payments in your tax return. So if you pull up your federal and also likely your state as well, tax return at the very end, you're going to see a list of suggested payment amounts, and they'll usually include mailing stubs if you're doing that by mail. And that's a lot of times going to be based on last year's income tax to help you avoid those under withholding penalties, but you still want to review throughout the year to make sure you're accounting for changes in your income from last year. And some of the biggest issues that I've seen, some of the biggest pain points with optometrists often come with first-time independent contractors that are not used to withholding their own taxes or making their own estimated tax payments. They've been used to having that done through their paychecks, and they're not used to paying self-employment taxes. And then they get to tax time and they're just sort of shocked and surprised by the amount of tax that's due, and they're scrambling to find the cash to pay that tax. Or the other scenario is where there's an early practice owner, like maybe you've cold started your practice and you're seeing really high growth in the practice from a revenue and profit standpoint, and you're not setting aside enough to prepare for the tax that's due. So you sort of run into this cash flow crunch. Those are some of the biggest issues that I've seen. So the more you can sort of proactively plan and project that out and keep up with changes in your income and set aside, plan your own cash flow enough to prepare for that, the better off you're going to be. I think this is just, a big pain point with taxes is, yes, you need to pay them, but I think also you're just unprepared for what happens at tax time. The amount due is higher than you're prepared for, and that can be frustrating. So if you're employed or relying mostly on payroll withholdings, the IRS also has a withholding estimator tool you can use. So I'll throw that in the show notes as well. And keep in mind, this is total household withholdings. So if you have multiple sources of income, right, it's going to be your total withholdings from all of those sources of income, or estimated tax payments, or only one. If you're withholding enough from one job to cover all of your sources of income, that works too. Or if you're married, keep in mind your spouse's income, of course, but also your spouse's tax payments and withholdings as well. So that's how, in general, the payments and tax withholding system works. Now let's talk about some deadlines. What are the deadlines to file your taxes? And that depends on whether you own a business and what type of business that is, or whether you're an employed associate optometrist. So if you own a business and you own an S corporation, or your business is taxed as an S corporation, or you own a partnership, your business has a tax filing deadline of March 15th. So we're coming up against that in the next couple of weeks. If you are filing your personal tax returns, those are due in April next month, April 18th, because the 15th falls on a holiday, I believe. So April 18th is your tax filing deadline for your personal return, as well as C corporation returns. Or if you have a sole proprietorship, it's the same thing. It's all part of your personal tax return. You can also file an extension before the March or April tax filing deadlines. You can file to extend your tax filing deadline. And that extension is 6 months. So for your personal tax return, that means you have up until October 16th, I believe, to file your tax return. Or if it's those S Corp or partnership returns, that means you have up until September to file those tax returns. And the reason those S Corp and partnership returns are a month earlier than your other tax returns is because you need information from those S Corp and partnership returns in order to file your own personal tax returns. You need to get that K-1 that shows you your own portion of profit and income from those businesses in order to file your personal tax return. And one other thing I'll say about extensions is that if you file an extension, that's only an extension to file your tax return. That's not an extension to pay the tax that's due. So you still need to, when you file the request to extend your tax return, you still need to pay your estimated tax by your April deadline. Filing an extension does not extend your ability to pay the tax. You still need to pay that tax before that April deadline. It only extends your ability to file your tax returns. So those are some deadlines to keep in mind. Finally, as we come to an end, let's talk about some tax planning thoughts, right? What are some general things to keep in mind as you are planning for your taxes this year, but also beyond? First thing I'll say is that there is a difference between tax filing and tax planning. There's also a difference in the professionals that help you do both. Tax filing is all about looking in the past, looking at the last year, collecting that information, and then filing it, presenting it to the IRS according to tax law accurately, and helping you to calculate the tax that's due. Right? So tax filing is all about looking at the past, filing, collecting information, and reporting it accurately so that you can pay an accurate tax. Tax planning is all about looking in the future. It's forward-looking. And it's looking at what may happen throughout this year, but also and especially what might happen beyond this year. And looking at what decisions can you make proactively in order to impact your taxes to put you in the best situation as possible over your lifetime, right? To manage your taxes as best as you can proactively over your lifetime. So tax filing is looking at the past. It's about collecting and filing and reporting information accurately. Tax planning is forward-looking. It's about looking to the future, what might happen, what laws will change, and proactively making decisions. And you'll want to make sure that if you're hiring professionals to help you with both, that they're able to help you with both. So that's the first thing that I'll mention. Next thing I want you to keep in mind as you plan around taxes is that there are a few major categories of levers you can pull in tax planning, at least the way that I look at it. You can control, number one, the timing of income that ends up on your tax return. So you can defer income into the future, meaning you're deciding not to pay taxes on it this year. You're going to push it off into a future tax year, or you can add income into the current year. You can accelerate it into the current year. Some common examples of this are if you're using a pre-tax 401k, you're deciding to not pay tax on that income this year, instead push it into future tax years. Or if you're doing a Roth conversion, you are taking pre-tax dollars that haven't been taxed yet, and you're adding that income into the current tax year, right? So timing of income is something you can control, often control. Or if you're in a business, perhaps you can accelerate or delay collecting revenue in the practice if you're a cash basis practice. So timing of income is one. Timing of deductions is another. Oftentimes you have a decision to make of when and how to take deductions. You can accelerate them sometimes into the current tax year, or you can take them over a schedule over several years. You can bunch deductions into certain years, like donations to charity, or you can spread them out over several years. Or you can control the spending and the way that you invest in your practice. So timing of deductions is another thing you can often control. Increasing deductions is another thing you can control sometimes. You can often control increasing deductions by either lowering your income and phasing into them more, or just controlling, like I mentioned earlier, your investment in the practice or things that you're purchasing. Or increasing tax credits. So those are some of the major categories of things to keep in mind as you think about your tax planning. Maybe you look at that tax formula I mentioned earlier and say, okay, what are some things that maybe I can control and that can impact my taxes? Next thing you want to think about as you think about tax planning is don't just look at this year alone. Take a longer term approach to your tax planning and your tax decisions. Most people want to just think about, I want to lower my tax this year. I want to get my taxable income down to zero. I don't want to pay anything. And if you look at almost any tax service that's out there, any tax filing service, what are they offering? Well, they're selling, we're going to get you the biggest refund now this year. It's a focus on the immediate refund. Well, not only does that refund not tell you anything about the actual taxes you paid, but it doesn't tell you anything about whether you made the right tax decisions this year or the long term. For example, sometimes it actually makes sense to add more income into the current year. An example of that is maybe you cold started a practice and you see your income drop to an unusually low level. Well, that may be an opportunity that you don't want to let go to waste to add additional income into that year so that it's taxed at a potentially lower tax rate than it otherwise would have been. Other years, it makes sense to increase deductions as much as possible or to defer income into the future. So take a longer term approach to tax planning. Some examples of where this comes into play are, number one, a common one is buying equipment in the practice, because a lot of times what you're seeing and hearing and thinking about is, I'm going to accelerate that depreciation into the current year. And that's basically what every vendor is going to be emailing you about at the end of the tax year. But you really have a decision to make. Does it make more sense to use that Section 179 to accelerate that depreciation into one tax year? Or does it make more sense to spread it out over the next several years, 5 to 7 years? And you want to think about what the next few years of income is going to look like. Or buying practice real estate, or really any real estate property. Are you going to take a cost segregation study? And if you do you want to accelerate parts of that depreciation into the current year? Or do you want to leave it at a shorter depreciation schedule? Right? These are longer term decisions to think about, and there's more than just this tax year to think about. Even using retirement plans, even just choosing to use a 401k, whether it's pre-tax or Roth, is a tax planning decision as well as an investment decision, because you are deciding, if you're using a pre-tax account, to not pay taxes this year, but instead push that on to future tax years in retirement. And then as you get closer to that, you may make decisions about Roth conversions. So all of that is really about, how do we manage taxes over your lifetime? Another thing to think about is, don't just look at those marginal tax rates that we talked about, the ones that tell you what your last dollars are going to be taxed at, but also look at your effective tax rate as well. This is something I look at too. Effective tax rate is just your actual total tax. If you pulled out your tax return, you found the item that says tax, total tax, your actual tax divided by your taxable income. That's your true average or your true effective tax rate. And it may not be as bad as your marginal tax rate says, or how it may look on paper. For example, if you were married in 2022 and you had a salary of $200,000 in the household, no kids, no other income, your top marginal tax rate was 22%, but your actual effective tax rate was only about 17%. So there's often a difference between what your actual true average tax rate was versus your marginal tax rate. And this comes into play if you're planning on adding additional income or thinking about getting additional deductions or lowering your income, because lowering your income may impact other types of income. For example, those investment types of income that are taxed at better tax rates. It may impact Social Security in retirement. It may impact Medicare premiums in retirement. It may start to phase you out of deductions or credits, or phase you into new taxes, or there may be social self-employment taxes to think about. So there's other tax impacts that will show up in this effective tax rate that you may not see by only looking at your marginal tax rate. I don't know if I explained that as clearly as I hoped. If you have questions on that, please let me know, and we'll talk more about that. The next thing to think about is just to be proactive as possible. Good tax planning should start in January, continue on through June, and then continue on through the rest of the year, right? This isn't something you want to think about in December when you're getting all those emails from vendors about 179 deductions. This is something you want to think about early in the year, at a very minimum, to get your tax withholdings and payments on track. To sort of think about, what am I planning to do in my practice? What do I expect the growth to be? What are things that I expect to be happening in my household? How is that going to impact my taxes? So be as proactive as possible. Work proactively with your own advisors. If your advisor is not at least collecting your tax return, reviewing it with you, talking to you about the tax impact of decisions, you need to think really hard about that. Talk proactively with your tax professional. Just be proactive in these conversations. The next thing is, please don't take tax advice from TikTok. I say that sort of jokingly, but I am just seeing the volume of really, truly awful tax and financial advice that's coming off of TikTok and now other platforms. And please just don't don't take that and run with it. Please talk with your own professionals, do your own due diligence. A lot of it, unfortunately, is really just inaccurate and wrong and will likely lead to a result that you don't want. So please, if it sounds too good to be true, it probably is. If someone is saying something that millionaires don't want you to know about, it's probably ridiculous. If someone is saying that your tax professionals don't want you to know about this strategy, it's probably something to ignore, right? So just watch out for all of that, just bad information out there. One last thing I want you to think about is don't let the tax tail wag the dog. And what I mean by that is that don't let taxes be the sole reason, or at least the primary reason, that you make financial or business decisions or life decisions. Taxes are a consequence to manage. They're often just a result that you want to manage as best as possible, but they shouldn't be the driving force of your decisions by themselves. A common example of this is a practice owner that wants to buy equipment in the practice just to get a tax deduction. That's not the reason you want to invest in your practice. You want to make sure that it's increasing your profitability, increasing your revenue, that there's a return on that investment. That's the primary factor. And then you want to think about how you fund it. Do you pay cash? Do you finance it? And then finally, how do you manage the tax consequence of that? Another common thing is really just people want to avoid earning additional income because it might push you into a tax bracket that's higher. Please don't let taxes be the driving force of all of your decisions. It's a factor to consider. It's a consequence to manage, but there's a whole host of other things that should be considered primarily before taxes. So don't let taxes be the sole deciding factor there. And with that, I'm going to wrap up my conversation here. If you've made it this far, kudos to you. You've listened to almost a half an hour or so of a conversation entirely about taxes. While I may think this is fun and exciting, I'm sure most of you probably don't. So, go outside, get some fresh air, get some sunlight, take a deep breath. You've made it to the end. But hopefully this is helpful for you in just getting an idea of how your tax system works. What are some things to think about in terms of how the tax rates work? How is your tax calculated? How do you make payments? Just how does this generally all work? There's a billion different bullet points to add and all the details and all this different stuff, especially if you are self-employed or own a practice, all the business stuff that comes with that. And I'm going to hope to continue to have more tax conversations in the next several episodes. But hopefully this is helpful for you as just a general overview. If you have any questions on anything we talked about today or anything else, reach out. You can send me an email at Evon, EVON, at optometrywealth.com. You can check all the resources I mentioned in the show notes at the Education Hub on my website, optometrywealth.com. While you're there, you can also schedule a no commitment introductory call to talk about all kinds of tax fun or just anything else that's on your mind financially and learn more about how we help and serve optometrists nationwide. And with that, have a great day. We'll catch you on the next episode and take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.